All right, good afternoon, everybody. Event Trader here, and we are about to kick off the latest version of the Sentiment and Flow Show. As you know, we've just gotten 48 hours of uh, big headlines, lots of key earnings coming out, tons of econ data. Of course, the Fed is well coming through. So, Brett and I are going to break all of this down and get into what we're seeing in the market right now. Brett, welcome to the show, of course. And I guess we got to kick things off with your S&P short here.
Well, it might be short-lived.
Fair
We're
enough.
headed right back there right now. This is one persistent bid we're seeing.
Yeah, it's just amazing, really, over the last couple of weeks now. It just feels like any attempt to try to muscle this down has been met with a ton of veracity on the other side, and really kind of kicks off with what we were saying, with what we were saying in our December Sentiment and Flow show.
Well, but
So,
even more so, do you remember a couple weeks ago on a Friday I jumped on audio with you
sure.
and we had like 20 minutes of just kind of and that really was right in front of this rally and we were kind of both saying, this looks like something that's going to be much more painful for people on the short side.
Yeah, no, I mean, we dove into the options positioning, and it's just something we're going to expand on today. And, we're going to cover a lot of the different aspects of what's going on in the backdrop of the markets. But yeah, shorting's been a tough game. I know I was able to get away with a little on my SQQQ last night. That was more just to sell the news reaction to some of these earnings. But talked about it this morning, and, a lot of the charts, Brett, that set up where we just had that big run up into 200-day moving averages, and then we were coming back, and I was setting up for a key test. And I got to say, I'm impressed so far by what the Bulls have been able to accomplish, given how extended we are.
Yeah, well, and I mean, it's been over the last couple of weeks. It looks like a one directional tape, but it really hasn't been. Like, there's been plenty of opportunities to play both sides of this market in the middle of it. Like, yesterday was a pretty good example. You can't even see my short in the Nasdaq, but that was 100 points plus over 100 points. Right off the Fed, actually, right in front of Powell's speech, and when he started um, coming, or Wednesday, when he started coming in, you know, and just gave his initial few thoughts, we saw the market dip, but the rally was so big, following that you can't even see it. But this market's been like that. The upside's been such gigantic moves over the last week or so that it really hides the swings on the other side. But it has been a two-way party for trading.
Yeah, yeah. No, it's just the entries have definitely been a lot tougher on the short side. I would say that. So, well, let's break down and see if we can figure out exactly why we are trading the way we are. We'll start off first by just taking a look at the AAII data out there. Obviously a little bit of an uptick in bullish sentiment. This is going off of the data from this week. Just saw bulls move to 29.9%, up from 28.4 in the prior week. Neutral a little bit higher, and bears down a little bit more. Now, there's a couple other slides we'll talk about, then we'll circle back here, Brett. But just looking at the historical averages, obviously very weak on the bullish front. A lot more neutral, pointing towards that choppy action that you're talking about there, Brett. And then, of course, we've got the little push higher here on the bearish side compared to historic norms. Then we can take a look at the AAII historical data and from the last couple of weeks, and you could just kind of see the progress that has been made. The first or the second column there is the bulls. The third neutral, then we got the bears. Then we're looking at that total 8-week moving average, which is at 25.48. We've really kind of just been sitting in that area there. But one thing that has seemed to improve recently is the bull bear spread, suggesting that a lot more people are just more in that neutral camp. And then we have here a chart of the historical chart of the AAII bull bears from Wolf Research that really just kind of highlights how bearish sentiment's been really for the past 5 to 6 months or so.
This
So
is the festering. Yeah, right.
that's
This
the
is
festering. So
it's the
why don't you break
context in
down your
front of
interpretation here,
yeah,
Brett?
so the context in front of a rally like this, and this is something we talked about last time. Like you get this festering situation. I mean, like you could see in the a couple slides ago, there was 5 of 6 weeks under 25 bulls, under 25% bulls. And that's a valid festering situation. That's way off of the long term average. That's people saying that over the next year, the vast majority of people are saying the market is going to be down. And that shows positioning. Nobody stays in the market when they think it's going to be down over the next year, at least not with anywhere near the same degree of financial engagement. And if you have that sitting there for a month and a half or 2 months where people are persistently feeling that way, the vast majority of active market participants are feeling that way, you can read through to positioning, and you know that you've got this opportunity that the second things start to pick up, there's going to be this fear of missing out bid, there's going to be this upside hedging, there's going to be something like I said yesterday, sort of an upward crash that we're seeing. It's people who were too bearish. You can think of them as kind of long only market participants who are too flat, or you could think of it as two-way participants who are too short. And what is a crash in a market? A crash is when you're on the wrong side of something that starts to go against you and you hit your risk threshold. And the same thing applies on the upside in situations where you've had this festering, where you've had a persistent dominant consensus opinion that has fed through to positioning for everybody, and then you start to see the market do the opposite. You hit a pain point and it really starts to accelerate on people because you just get emotional emotional shifting of that positioning en masse, where everybody is in a consensus wrong-footed state. And that's what we've seen.
And very similar, obviously, the last time we saw an environment like this would have been right around COVID, right? In the mid 2020s, there, as we could see on the chart. Even a more aggressive this time around, Brett. You could see it clearly lays out that standard deviation when it's plus or minus two on that front, just to kind of show extremes. And we didn't even get to these extreme levels in 2020s. Do you think this is just kind of the idea that given the expansion of social media and all that, people are just simply jumping into the same boat a little bit faster, thus leading to those extremist swings?
Well, no, I mean, I just think it's the evolution of a bear market.
Yeah,
And I think you just get people, they just it's kind of like it's kind of the old Elliott wave thing, is that there's this third factor that people don't think about, which is sort of the social mood. And I've always kind of bought into that a little bit. And market prices are discounting future economic events, but both of them are really kind of going on a third thing that we could never make a chart of, which is just sort of everybody's sort of mood, collectively. And it just kind of feeds through, and people are just, they're just there right now, and that leads to a malpositioning in markets. And I think it does. I think little everyday interactions with people, just at the grocery store or in a cab or whatever, it just translates through society. There's just sort of more pessimistic feeling about everything. It's just contagious,
right.
and it
It's
leads
the
to this
talk of
malpositioning.
recession leads to a recession, right? Along that same
Exactly, right?
theory.
And there's just, everything's going wrong in the world. And it just kind of, it doesn't mean that anything is necessarily worse. It's just when you pass certain thresholds of enough people feeling that way, it's just sort of culturally contagious. And I think we go through these phases. And that's why sentiment data is so good, because you get everybody kind of positioned at an extreme threshold, and there's really nowhere to go but the other way, because you just kind of like there's just aren't enough potential future sell orders. It's like that sort of market composition model that I've posted a few times. Like, you can map the market out in terms of what orders are likely to come because of what positioning exists now. And even if people feel bad, if they don't own any stocks, it's not going to impact the market.
Right. No, exactly, because there's nobody left to sell, basically, right? So, um,
Exactly.
well, the AAI, are you surprised that we didn't see a bigger jump in bulls this week. I was kind of expecting to see it push back over to 30 level myself.
So you got to remember that this data, I think it closes on Tuesday afternoon, which is before the Fed.
Pre-Fed, right? So
Right. So I think that the data set doesn't include the 2 days of real upward craziness.
next week, you think we see a big pop to like
Depends
35
on
or
what
so?
happens in the next couple of days, but yeah.
Fair enough. All right. So let's talk a little bit about the Fed. Nice segue here for us. Just a quick recap of some of the highlights, and by all means, Brett, feel free to jump in if I'm missing anything on these bullets. But they raised by 25 points as expected. They said ongoing increases would be appropriate, but they did tamper that down a little bit. I know you pointed it out, Brett. The exchange of pace to extent, which was no longer really so much about trying to figure out how fast they need to raise as much as how high they need to go. Um, you know, Powell did mention some signs of disinflation. We'll get into some of the disinflation charts here, or some of the inflation charts here in a second. One thing that I found was interesting was Powell did dodge the question when he was asked specifically about whether or not the Fed had discussed the pause, and he said that we need to that will be revealed in the Fed minutes. So that's going to be something that people are really going to be taking a look at in about 3 weeks or so when we get those out. Powell's base case he was for a soft landing. One thing that I found interesting was a comment that he thought state and local governments could cut tax rates, which it's a move by a Fed chair that you don't usually see, but that was in his discussions with some government officials there.
Right. Well, I
He,
mean, my interpretation of that, just real quick, is just
yeah,
I've seen other information on this dynamic, like that. This is they're like at record thresholds of cash. So
right.
I think he's actually coming at it not from a policy recommendation standpoint as much as just from like how do we predict what's going to happen? We look at this data point and we would predict that this could happen.
Right, exactly. So, I mean, a lot of people still flush with cash from COVID money and things of that nature that's
Well, and
still
the
sitting in the
governments
system.
themselves, I mean, like their governments
Exact,
are
but that's what I'm saying.
taking a lot of that money.
Yeah, no, exactly, and that's what I'm saying. They're
Look
sitting
at
on it.
wherever
So,
you live, everybody listening, look at how many roads have recently been repaired.
yeah,
Because I've seen it everywhere. It's like, man, everything is just suddenly much nicer roads.
yeah. No, I would agree with that. You've seen definitely bridges getting worked on, things of that nature for
Yeah,
sure. So,
they got the
uh,
budget.
the budget's coming out, and obviously we'll talk a little bit about the debt ceiling in a bit. But for me, Brett, I would say the biggest thing for me for Powell was the general interpretation was, oh, he was dovish, and there's certainly the aspect that he didn't come out like Jackson Hole, like he had an axe to grind with with equity markets at all or anything like that. Certainly the timing and the pace of where we're at and everything was far different as well. But I didn't think he really struck a dovish tone as much as he struck a confident tone in the idea that the economy was strong enough that it could handle these rate increases. And for me, that was the bigger thing, as that if he came out dovish, Brett, I would have been kind of worried. It's like, what's he seeing that he's so
Hmm.
concerned about that he wants to hold? But that wasn't the case. He just felt that, the plan that the Fed had been laying out was working, and that the economy was digesting it, and that there was enough money in the system to handle the rate cuts. And I thought that was an important distinction. I don't know how you felt about that.
So I get what you're saying, and I would take it one psychological level further, which is I think the biggest factor is that he didn't feel like he had to shut the market down. Like he wasn't talking from the standpoint of one of our responsibilities right now is to prevent too much loosening of financial conditions. Because he
Right.
had he had every opportunity to do that. And he very
Talking about
clearly
asset prices,
he
whatever it
just
could be.
yeah,
Yeah.
he very clearly was just sort of like I think that one of the biggest upside fuel points is just he very clearly was just like, well, here's what we think and here's what we're doing, rather than, you know, this messaging has been designed because we think that we need to shut down risk assets. And because
Right.
if he does that, then you're just going to get a lot more of that. Like there's just a cap on the market because they're going to say what they need to say to try and stop the party. and he just was talking about, you know, economic issues and policy issues from the monetary side, and there wasn't any sense to me that, because it's been I mean, think about Jackson Hole. Like, there was a very clear, like, he went into that thinking we need to shut down the risk assets. Like,
Right.
everything was just like, you people think this is over, you are crazy, we are going to hammer you. And this was just sort of, hey, we'll see what comes. So it's
Yeah.
just a different feel.
Yeah, a complete different feel, and I think it caught a lot of people off guard because I think a lot of people were expecting him to kind of go that route
Oh,
and
I
the
totally
the
was.
whack a
Yeah.
mole. Yeah, no, I certainly was for sure, which is why I had that SQQ on, which I ended up getting trucked on pretty
It
in the
happens.
attempt to do that. But let's talk a little bit now about some of the rate expectations and the inflation numbers that are um, kind of moving forward. Now, we're keeping an eye out on the CME Fed funds futures. There wasn't a big change on it. There was certainly a part of the camp that moved from the above 5% camp to the below 5% camp. Now, I'm seeing that reversed a little bit here following that monster jobs number, Brett. So, in talking about the
Absolutely.
rate expectations, we do have this chart from the fund managers survey, just kind of seeing. Now, this would have been taken, some of the FMS data that we have here is a little bit dated at this juncture for us, so doesn't take into consideration the past important 48 hours of activity. But you could see that lower short-term rate expectations were certainly on the rise here. So what's your thoughts about where the market's positioned on rate expectations? Do you have any issues with the CME Fed funds futures placements right now?
Well, so first of all, I think the last 48 hours has been a wash
Okay.
in a lot of ways. I mean, like, when you take into account what we saw on Wednesday and then suddenly what you see today with with the jobs data where it came in, with ISM services where it came in, I think that, 3 weeks ago versus today, we're in the same place as far as rate expectations. I can't see any difference having.
Fair enough. None of the earnings or anything like that's caught you off guard or anything along those lines.
I don't think anything was shocking
Yeah,
from the world that we thought existed 3 weeks ago.
yeah. I mean, this jobs number was a little, but there was also a lot of revisions,
You're,
annual
you're right. The
revisions
jobs
taking
number
place.
was
So,
was the only thing that was shocking.
yeah,
Yeah, I don't think anything else was shocking. I think that was shocking.
I guess some people would argue maybe Powell's approach on the call was a little shocking. Perhaps I wouldn't say shocking. Maybe that's a little bit too
Well, but they
aggressive of
kind of
a term.
even out again. You like
Yeah, fair
if
enough.
we were to talk to him right now, he would have a different approach.
You don't
I
think
guess
he
that's
had
what I
any of
mean.
these numbers in his back pocket?
I
He
do
had, he
not.
had
I don't think there's any way he would have sounded like that if he knew we were going to have 500,000 plus jobs in a 3.4.
Okay, fair enough.
No, do you think? I mean, I don't
I
think so.
I gotta think he had that number like pretty much at the ready before he was sitting down, don't you
I don't
think? I
know,
mean,
man. I mean, they're pretty efficient if he did.
yeah.
And I mean, I don't.
Well,
I
because
guess I
all the
get what you're
data's
saying.
collected by then, right? You would
It's
think that he would
collected,
call
but you've
somebody
got
up there and be like, "Hey, don't make me look like an ass. What should?"
yeah,
Because
but then you've
it
got
definitely,
bureaucracy involved, and I mean, how efficient
yeah,
are what are you expecting? This is who's doing this?
yeah, yeah. No, that's fair. That's fair. So,
I don't think that this is a smooth, well-oiled machine.
come on, you've been to the DMV, you know how that runs. So,
Exactly.
but no, that's fair enough. So you think rate expectations are on par with market activity? Would
Uh, yeah, I get. Well, I mean, clarify that question.
so in terms of the move that we've had and where rate expectation, like you don't think anybody's offsides in terms of thinking rates
You
could?
mean policy Fed funds rate expectations?
Yes, yes. Fed funds rate compared
Oh,
to where
again,
we
so
stand with the market
here's what.
expectation.
Listen, I think all questions like that can be answered by the same thing. So I'll say this: the narrative that justifies, and we talked about this a little bit over the phone before this. The narrative that justifies what we're seeing about everything. If you think of the world like there's a potential future where looking back from there to the now, we would say this is what the markets were all pricing in. The narrative that makes the most sense, and this could be wrong, but in one potential universe of the future, what this would be happening, what we'd be seeing right now, is that team transitory was ultimately vindicated. And inflation over the past year and a half is really just all down to reopening dynamics from the pandemic. Supply chains playing a big part. China's reopening is kind of the end point of that, and we're returning to a lowflation environment. And also, oh, by the way, the economy is booming. And so, I mean, that's a world where if you haven't positioned yourself for that, and suddenly you're starting to worry, like let's say you manage a, $1 billion long only equity only fund, and you didn't think that's what you were going to be seeing, and you've got way too much cash, and suddenly you're starting to say, what if that's the future? That explains, and we're going to get to the call activity in a little bit on the Lobo side, but that explains the massive jump in institutional call buying that we've seen over the last, like, 3 or 4 days. So that's one potential future. Maybe it's only a 10% possibility, but if you had it as a 0% possibility, and suddenly you're starting to say that, it's not necessarily that impossible that that's what we're coming into, then that justifies everything, and it justifies the rate expectations and everything else. It's that at the end of the year we're going to see rates lower than they are now, but we don't ever even see anything even close to a recession. All that's explained by the idea that ultimately we're still in a very long-term structural lowflation situation with a blip of 18 months to 24 months of high inflation based on coming out of the first global pandemic in 100 years. And that's not an unreasonable point of view. And if at the end of the day, it might be what the market's starting to try to say, price in by some percentage value. And that there's this longer term structural factor that's due to demographics and everything else that's really just going to keep a lid on inflation for a long period of time. I don't know that that's right, but if you haven't been considering that as even remotely possible, Team Transitory lost in a body slam a year and a half ago, or less than a year and a half
Right.
ago. But suddenly, with China reopening, if we start to see, I mean, you got a chart coming up on like the crash in container prices, and all that's fed into the supply chain loosening and opening up. And we got a war going on. What if that ends soon? And suddenly you're faced with no equities exposure, and we see 500,000 jobs numbers and inflation tanking. You're screwed at that point. So, like, I think a lot of this is just how do you balance your field of outcome distribution? And if you haven't had any part of your plan, your strategic positioning plan, taking into account any possibility of that outcome, then suddenly, yeah, you're going to see, 250,000 spy calls bought in a day or something, because everybody on Wall Street has had, 6% cash, and you
Right.
can't you can't live in that world.
Right. And taking a look at some of these inflation just slides, just to kind of give you the idea. Number one, we just have this expected Fed funds rate. As we could see, there was a big uptick. This is from again the fund manager survey, the December 22nd to January. You had that decline from the 525, and a lot of people moving into that 5 to 5.25 area. A lot of people in that 475 to 5 area. So a little bit of downtick there. And then, you know, turning towards the inflation numbers that we were seeing, you could see that big divergence going on between prices paid in manufacturing, cost of goods, and the prices paid in services, the cost of services. But that is declining, and that's obviously what Powell and company are looking to play a little bit of catch up on. Continuing with some of these slides, Brett, the one that I wanted to chat with you about the most is this core services X housing, which Powell specifically laid this out as the most important inflation tool that they are using. And you can see that was on the decline. It's a little bit of a pop up higher. This is data taken from the St. Louis Fed here. But it's a number that we're going to watch pretty closely. And basically, what the Fed's doing is it's acknowledging that the pandemic disruptions led to inflation in a wide range of sectors, obviously, and basically that inflation in core goods and housing is analytically distinct from wage driven cost push inflation. So, they're kind of changing that up a little bit. So, what's your thought on this chart? And, is this something that you're going to be following closely?
Yeah, sure. I mean, so the other side of the exact thing that I was just discussing. So there's this world where what if Team Transitory was right? The other, the opposite, the polar opposite world is we've seen tailwinds on the disinflationary side from reduced. So the goods has been collapsing, and commodity prices. If you look at, like, the price of gasoline, you look at gasoline futures over the course of the last, like, 6, 7, 8 months. I mean, really, basically since last summer, it's just been tanking, right? There's been a number of
Yeah.
factors like that, and when you push that into CPI, like, there's a huge tailwind on the downside for CPI coming from everything other than basically what we're talking about here, the sort of super core services side. If that's sticky and that remains where it is, and we've seen, like, services is at like 7% something, and if commodity prices start to turn around, and look at this jobs data, not a crazy idea.
Yeah.
And goods prices start to turn around. Look, wages was revised higher for December. Then, you got the sort of opposite universe. You've got the world where we're going to head back to 8% CPI over the next few months, and the Fed is going to have to increase the terminal rate to, like, 7%. And we're going to be going right back through the washing machine again. We're going to go right back through last year starting pretty soon. Like, that's another universe. And it's not impossible, because again, we've seen certain factors collapse in CPI, and this is the factor that has not. And if this just sits where it is and those other factors bounce back, we got a very, very different universe.
Right. And that jobs number doesn't help out with this figure either, right?
It
So,
certainly doesn't. Yeah, exactly. So it's really remarkable the way that equities are acting today,
yeah.
for that. Yeah.
All right. And then just real quick, just flying through food prices, obviously on the decline. This is from the IMF here. There's that world container price that Brett and I were just talking about. Look at that collapse there, Brett. Really slipping on that front.
It's a
Certainly
Christmas
China
tree, right?
reopening.
There,
Yeah.
there's team transitory, exhibit number one.
Yes. Yes. So, and then price elasticity, another key item. This is from the NFIB survey. Companies that have said that they plan to raise prices in the next 3 months. There's no longer can they push their expense burden onto the consumer here.
Right.
So,
Consumer endpoints are inelastic. And
yeah,
that's a big team transitory exhibit number two.
yeah. Pepsi tries to get more for their 2 liter, no one's buying it. Basically, is what that's saying.
Right.
So,
And that's huge. I mean, for
yeah,
the long term inflation output, that's enormous. And, you look at what Japan's been going through for decades. It's been like, every time things start to tick up there, there's no elasticity.
exactly. All right, so let's talk a little bit about the market characteristics here, Brett. Obviously, we got that melt up there. Institutions not positioned for the rally, as we've been talking. That's something we're going to dive deeper into. Soft landing expectations on the rise. I think the Fed remains hawkish, but forward guidance influence is waning in terms of, those Kashkari. We're going up to 7 and stuff hasn't really been heated at all by the markets. Earnings, and we'll talk a little bit deeper about them in the better than feared stage. Fed easing expectations, driving thematic and sector rotation. That's something we'll discuss a little bit more. That's a question mark, obviously. Speculative names have been bouncing sharply to kick off 2023. The bull bear indicator that's rose to 4.2 from 3.5. This is the highest since March 2022. So we are starting to see a little bit of that rotation into the bearish camp that we were talking about. Big tech earnings, of course, just disappointed. And then options activity, which we're going to get into right now, Brett, it's retaining an outsized impact on the trade. So we got two charts here, the Lobo activity and the Robo activity. So why don't we go through and kind of discuss how that's impacting this broad market action right now. Starting, of course, with the Lobo activity and the institutional money that's piling in here.
So let me give you just an idea of what you're looking at right there. So the spike to the upside gets us back to a place on Lobo. So this is um, large only buy to open options activities, clearinghouse data. It's if you're doing really, 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 really big options orders. So you're getting down to $1 billion funds basically, in that sample. So this is what they're doing in the options market. And the highs of the spike means way more puts than calls, right? So the higher it gets, the more puts to calls. It's a ratio puts to calls, and it's buy to open. It's establishing new positions, and the spike that you see gets up to areas where look, you can see on the left hand side of that chart, you can see the pandemic. So way more puts than even they were buying in the pandemic crash. And if you go back even further than that, it's kind of similar to what we saw in the global financial crisis. And this is during this period. So they were buying that much in terms of puts. But it's all reversed over the last couple of weeks, and we're right back down where we were, which is, to me, it is basically kind of protecting against an upward crash potential. It's institutions being really, really bearish, and then suddenly seeing the market start to move against them, and starting to contemplate the possibility of that world where team transitory ends up being vindicated. And actually, I'm just stopped out of my ES short.
Yeah, just hit 41.91 there.
Yeah,
But you
which
did you
was
you you did limit your risk there by tightening up your
oh no,
shorts
yeah, right,
with your
barely.
stops, which is prudent in this junction in this market for
Yeah,
sure.
well, and after scalping a piece on the downside, so actually I ended up slightly positive on the trade, so that's all
Yeah,
right. But it didn't
that'll
turn
work.
into what I was looking for. Either
Yeah,
way,
just a little fishing, just a little fishing, right, Brett?
yeah, well, I started pre-market thinking, we're going to see this
Yeah.
ramp up, and then we're going to roll it over, and there's just more persistence to this bid than I was expecting. Anyways, so what we've seen over the last week or two is just this huge rush into calls, enough to completely kind of mediate this ratio. And it's been on the institutional side. And the next chart will show you that has not been nearly as aggressive on the retail side. It's been institutions basically hedging against the possibility that the market is much more viable on the bull side than anybody had been positioned for.
What do you think? Do you think the robo activity? And I have flipped over to that robo chart, Brett. Do you think it's because it's just remained elevated and therefore didn't have the catch up distinctions that the institutional side did?
Well, a little bit, but I mean, it's pulled back some. It's certainly, there's been call buying there. It just hasn't been as dramatic. But this shows you the sort of long-term picture, so you could see Robo. This is truly one of my favorite indicators for a long time in terms of big turning points in the market, and you can see, where we were when you and I were talking a bullish game in late 2020, and saying people were positioned way too bearishly, in terms of the pandemic. This was one of the big indicators that we turned to a lot. And you could see how low it was during that period, well below that bottom red line. And just people so bearish, buying so many puts constantly. And then, people shifted. You could see the first initial push, which was way up to where we are now, right? And then it sort of leaked down, and it went into this call buying period when we got near the top. So actually, flip what I just said, but you can see how it festered around those highs, and then we came off into the bear market, and now you can see a rip back up. But it's really disproportional to me in terms of just how many puts were bought. This is equivalent to what we saw in December of 2008 and January of 2009, right in the middle of the pandemic, or right in the middle of the global financial crisis. And then in 2002 and early 2003, right when we were at the end of the dot-com bear market. And now, I mean, you can't really equate the kind of bear market environment that we were in 2008 and 2001 to what we saw last year. I don't think so. I don't think anywhere close. And it's really interesting to see that people are just as aggressive on the retail side, on the put side in that situation, which is a contrarian signal of a big major bottom. I mean, you can see the three green vertical lines ahead of this one, back in 2002, in 2000, late 2008, and in 2020. They're all at the same level in the robo that we're seeing right now, and they all represented major bear market lows. That doesn't necessarily mean that this is going to equate to the same thing, but it's a big signal. It's a big signal about where people are positioned and where sentiment is. Now, if I were to play devil's advocate to myself just a little bit, I would do so by saying I think that since the pandemic lows, we have moved into a universe where the options market is concerned that's fundamentally different. And we've talked about this a few times. It's kind of a sea change in terms of where participation is across markets, and it's possible, though not necessarily definitely the case, but it's possible that that spoils this indicator. I don't know whether that's true, and we probably won't know for a long time.
Do you find this rally might be a little bit more susceptible to a reversal because of the leverage that's being put into play here, and kind of like the short term gratification just in the catch up side of things, where if somebody was buying calls on the institutional side at a heavy rate and didn't believe in this market and were ready to bank profits pretty quickly and step to the sideline, that we could get that steep drop, a little bit of a trapdoor activity.
I get what you're saying. I think that could play either direction, honestly. If everybody's playing the options market and we've got this, big sprint into puts followed by this big sprint into calls, I it's generally a more volatile situation, but volatility can happen in either direction.
All right. Moving along here, growth prospect spread. Obviously, that soft landing debate starting to take hold, as we've been talking about here. Um, just that is on the rise, playing a little bit of catch up. The S&P, while it's bottoming here, that's starting to move up too. So we'll watch that. Obviously, that tends to front run some of the action going on in the S&P. So that's going to be something that we'll continue to watch. One of the issues is market valuation here. Certainly frothy at these levels, and we'll talk about the earnings in just a second. Do you have any problems with the market valuation, or do you just find this not a very helpful tool at this juncture?
Well, you know what? One of the things I saw Craig post a few days ago that I thought was remarkably interesting, and I hadn't realized this before. I don't know if you saw the same thing, but he said if you take out the mega caps, the S&P is at 14 times.
Yeah, yeah, the small. I mean, there's a lot of catch up to be done, but I guess some of the problem is, and we've certainly seen the breadth. But if you're looking at the small and mid caps, it's one of the reasons why I got into the IWM. The IWM small caps are trading at like 13 times forward earnings. So
Well, let me say there's two ways to look at that, though. So one way is the way
yeah,
that you just suggested, which is there's valuation multiple catch up for the bulk of companies, or the other is you know universe is basically that there are certain companies that have basically I guess if I want the way that I'll put it is it's kind of like um um the FTC has blown it, and we've got a few companies that really do have monopolies, and they're of course going to grow more than everything else, and therefore they justify a higher earnings multiple
right,
because we just don't have the tools to actually properly regulate the business economy anymore, and we've got a
yeah,
really outdated way of understanding what a monopoly really is, and that it's going to be years and years and years before we're able to come up with the theoretical tools to be able to really shift that situation, because these companies are smarter than people working the FTC. And so really what we have is monopolies which are going to be worth more than other companies, and they're going to grow faster than other companies, and they can cultivate and farm their own opportunities. But that if so they're not necessarily that vulnerable at a higher multiple, and the rest of the market is priced historically at a fine level.
yeah. I would also note one aspect of this chart that's important is that the forward PE tends to run in front of the EPS and vice versa. So, this right here suggests that a lot of the EPS decline that's expected is being priced into the markets at this juncture. So, no surprise there, as the market's a forward-looking instrument, but an interesting aspect of this chart. Moving on, just year-to-date returns. Of course, Nasdaq out of the gate strong here. S&P, U.S. corporate investment grade bonds seeing a lot of strength. Brett, obviously, it's a pretty nice yield that you're getting there at this juncture. Treasury is a little bit of a boost. So, any crude off to a decent start, or it's lagging a little bit, but still in positive, and gold off to a decent start. Any thoughts on any of these returns?
No, I mean I think the main thing we haven't talked about much is just the dollar trend change has
Yeah.
been massive, and it probably is completely explaining that slide.
Yeah, no, it certainly helps explain it. And when you step back a little bit, it's looking a lot like 2017 in terms of where the leadership is. Of course, in towards the end of 2017, again, we're starting off on a rate hike cycle, right? The Trump tax returns were expected to kick off in 2018, which had the Fed looking to get in front of it. So that was one key aspect of looking at this that really lined up in terms of what was the same in 2017. So 2017 turned out to be a pretty good year for the tech industry. It was up 40% that year. So just something to kind of keep in mind if you're looking for markets don't always repeat themselves, but there's a little bit of rhythm going on there.
But
And
what's strikingly similar about those two contexts? It takes a little leap right now, but if you think that the Fed is too accommodative, then they're the same. You've got
yeah,
strong growth and stimulus at the same time. Because that's 2017. It's like fine, the Fed was starting to tighten, but the the tax cut was by far and away the bigger factor. And it was
right.
a huge carrot out in front of the market. Like it was ridiculous how it sequenced together, having an economy that was already that strong, and then doing something that was a gigantic fiscal stimulus at the same time. It was a
Yeah.
massive fiscal stimulus when the economy was already strong. Like
Now,
that like if you think if you like so if we see the same kind of overall tone to things right now, that's one way of saying, you know, the Fed is way too accommodative right now.
right. Of course, the Fed rate hike cycle in 2017 obviously disrupted by the trade wars that kicked off in 2018, which helped offset some of those tax
Yeah,
hikes.
but just in terms of 2017 versus this year, like this slide suggests they're looking very similar in terms of asset distribution and in terms of performance. So one way to filter that, and I'm not saying this is necessarily correct, but one way to filter that is, this is the sort of thing we see when you have strong growth and also too much stimulus.
Right, right. So that is something that we'll be watching because Fed is getting into restrictive territory now. So, and if you're curious, the Fed rates back then, is rising up from 1.7. It was right around 1.75%. So,
But it's
uh,
all relative. And look at this
yeah,
jobs report. I mean, maybe the Fed needs to be at 8%. Like it's all relative. So like maybe they're just way undershooting the mark.
yeah. Well, that's something that's going to be determined in the next couple of months, right? So,
Right.
if they can't stomp out that inflation, so that's something that bears watching. All right, just keeping this flowing here. Q4 earnings, just going to fly through these. Obviously, a number of names out last night. We'll get deeper into it, but one of the interesting aspects so far this earnings season's been growth producing value. Just looking at growth, EPS has been up about 1.9%, revs up about 5.4%. Where value, the EPS has actually dropped 6.8%. And revs is only grown 3.4%. So you're just not seeing some of the outperformance I think that people were expecting in this higher rate environment. And that's another one of the reasons why I think you've been seeing money flowing back into that tech space. Domestic EPS has been outperforming global oriented peers here. So, but that really hasn't stopped the flow that we've seen into the global economy here. And then guidance on track to be the weakest since 2011. And this is the numbers that we're looking at here. These are the revenue surprises, as you can see. The lowest amount since the first quarter of 2020, which of course, nobody knew how to really price in what was going on with the shutdowns around COVID, and that made for some very difficult times here. Then earning surprises lowest again since that same period there. Just really just not out producing on any of the fronts. And then earnings price reaction, though, surprisingly, we've seen companies hit less against these weak results, which Brett to me suggests that a lot of this had been priced in. But this slide here shows the price action one day before to 2 days after the reported data. And you can see in the past, if companies missed, they were getting hammered. Not so much this time around, which I thought was pretty interesting, and just kind of really highlights the earnings season that we've been getting in under so far. So,
And the
Brett,
positioning situation that we had coming into it.
and the positioning coming into
All
it. So,
those puts.
Brett, real quick, what was your thoughts on the big tech names, starting with Meta and Apple, Amazon, and Google? Not deep dives into it, but overall thoughts on how that impacts the psychology of the market here.
I mean, I always would defer to what the market does in a situation like that because I can have my own judgments. I'm worried about Chat GPT for Google or something, but I mean, you look at what Google rant on Meta, and then you know didn't give everything back. I mean, that right there, like if you were sitting there coming into yesterday, Alphabet, Apple, Amazon, and you're shorting everything coming into that, thinking this is my magic bullet. It's going to make everything okay for me. I've been getting hammered over the last couple of days, but finally, we're going to get the real corporate data that's going to justify my shorting into this period because these companies are going to tell you that the world's a terrible place and that this is going to have serious ramifications for coming quarters. And here we are, you know, haven't
Yeah.
lost a step. So, I mean, however you want to frame into the weeds, like here we are.
Certainly the idea that the first half of 2023 is simply going to be weaker, but there's brighter skies at the back half that continues to
There's
take
looking around
hold.
the corner, and
Yeah,
there's also outsized economic strength right now that maybe people weren't anticipating. And that I mean, there's all sorts of issues. Apple obviously has all sorts of issues. But there's it's not as hard to look around the corner if you start to think that you could have a strong economy,
strong consumer.
strong consumer, flush government, and and also, maybe team transitory turns out to be right. Like you're screwed if you're not on board and that happens.
Yeah. All right, just going through some of those. And Bank of America Fund Managers survey, a few of the highlights here: 6-month low in recession fears, which falls into those growth prospects we talked about. China growth expectations at 17-year highs. We'll take a look at some of these slides real quick too. Fed funds peak at 5%. Monetary policy seen as restrictive for the first time since March 2020. Cash dropped off here to 5.3% from 5.9, the biggest drop since June of 2020. Inflation remains the biggest risk to people, which again, when Brett talks about that team transitory being right risk that's out there. Long US dollar is surprisingly still the most crowded trade here, Brett, but you have your own theories on this particular question. The Dixie has now declined 12%
Yeah,
since
that's
October of
crazy to me.
2021.
That's
Yeah. And
crazy.
then allocations overweight cash and bonds, underweight global. So just going through underweight stocks, Brett, this kind of falls right into what you've been talking about all
Well,
along
U.S.
here, right?
stocks, but yeah, yeah,
Yes,
yeah.
underweight US stocks here, just to be clear. That's again
But I don't
points
think
to
that's a
Brett's
huge
catch up
distinction. I think it
positioning.
probably plays through. But yeah,
Yeah, yeah, no, that's definitely playing through. But you
that's
could
the
see
Lobo chart we saw
where
earlier
the lows.
is this.
And again, just going back to this 2017, Brett, this is the lowest we've been since, or the lowest we've been since 2017 on that front. So
Right.
just kind of, again, reflecting that 2017 aspect there.
So you
Uh,
see
ca-
a couple 100,000 spy calls bought in a day. That's why.
yeah, yeah, exactly.
Hedging.
You got your cash levels here on the decline Brett. Lowest since April 2020 here. You could see that October 16 drop going into 2017. Very similar drop going on right now. Futures positioning. This again points back to your leveraged positioning there, Brett. And people are just a little too late on this. So certainly starting to pile in back into those positions. And just one more slide on US equity allocations here, far too low. Which brings us to this slide here, Brett, which I find interesting. S&P projections. Should we just throw this slide out the window? As we've pretty much caught up to that 4,200 level. You can see where the market is, or perhaps this is reflective in what you've been talking about and people being under, in terms of people being underinvested.
I would say that so I would say you got marketing conflicting with opinion here. So when you get I think even in a private survey, wherever you get, if you say what's the projection, somebody whose livelihood is based on the general public being willing to stay in their 401k positioning in the stock market, they're always going to slope this estimate toward the upside to me. I think there's always a skew there. Whenever somebody says, here's what our estimate is for the S&P at the end of the year, there's always a bias to it that is skewed to the upside based on what they really think, because that's like you need to have people believe that the future is going to be okay for stocks. So I genuinely believe that. So I think what you see here when you say that the number one spot has 3,800 in it for the entire year, we're well above that now. This is another, that should be at 3,400
Right.
if it were honest. And and so I think that this is another reason why we've seen all those calls bought, is that they're positioned for 3,400.
Right. Agreed. Just taking a look at the January rotation, no surprises. Eurozone, emerging markets, you got that EEM trade out there. Um, Industrials, cash, saw some rotation in it. And then you got that month over month change in position for U.S. Uh, equities, healthcare, tech, bonds. So I do think that again, this was run on the 17th. I don't think that this would be as aggressive as some of the position rotation as we're seeing. So probably a little bit of a dated slide here. Would you agree with that, Brett?
Yeah, absolutely.
Okay. Then last two slides here. Long US dollar. We were just talking about that. Long ESG assets. That's viewed as a crowded trade. Chinese equities moving on for the first time, as a lot of people have been piling in there around the reopening. Long oils moved back just a little bit. And then for the first time on this, we're seeing long US treasuries and long IG bonds. Does that knock you over with a feather, Brett, seeing these bonds on for the first time?
Yeah, actually, yeah.
So it's something we'll continue to watch. I got that TLT trade out there. So,
But
we'll
I mean, look,
I think it's
rates are
just such a safe return, right, Brett? I mean, I know I
well,
just put a bunch of money in a CD that's a 3-month CD that gets 4.3%. How can you frown on that kind of a return
especially
over a
given the
3-month
last 10
period?
years that we've seen. Yeah.
Yeah, exactly. And finally, the tail risk, inflation staying too high, obviously. That jobs number is going to continue to bring that up. Deep global recession, well, it's a risk every year, right? Central banks staying hawkish. Again, Powell kind of disrupted that a little bit, but, we'll see if that jobs number changes it. So, Brett, anything on the tail risk jumping off to you?
Well, I mean, 1 and 3 are the same thing. So, and 2 is the consequences of that 6 months later, and 4 is unknowable.
Yeah,
Five is with 2,
yeah.
and 6 is unknowable. So,
Yeah, it'll be interesting to see what goes on with the that the spring offensive that supposedly Putin's getting under. So it's something that we're going to be watching
well,
closely. I
they got
think
the
it could
hard
be.
ground again, right? Didn't we talk about
Yeah,
that last year about this time? It's like when you're in a swamp
and,
there, and we didn't really realize that, and during the winter you can actually roll big machinery over top of stuff.
I would say it was realized. I mean, anybody if Napoleon
Well,
couldn't
okay,
get
fine.
through with the horse.
I didn't realize it.
Uh,
I learned something about
I,
Ukraine that I didn't know.
ask Napoleon and Hitler how Russia is in
Oh
the
yeah, right. Or Eddie Izzard. Yeah. But
Eddie Izzard.
hey, Ukraine's now got. Did you ever see that? That's so funny.
That is funny.
Yeah, yeah. Oh, it's a bit cold. It's a bit cold. But yeah. So, but the other thing is, I mean, Ukraine's now got Abrams tanks and Leopard tanks, and I mean, I don't know if it's the same as last year.
Yeah, yeah. It's going to be an interesting aspect to go through. I saw something where Russia has lost 200,000 troops. Who knows if that's right or not? But that'd be a staggering number for Putin to answer
I
to.
believe it. I
Yeah.
mean, I guess it's propaganda on both sides, but I would believe it given some of the some of the planning.
Right. All right, Brett, let's wrap this up here and recap it. I mean, from my perspective, some of the things that I think easily the most important aspect of the market uncovered is just that lack of that lack of exposure to the upside that you've been highlighting so well here. And people are looking for reasons for this move against the fundamental backdrop, which you could argue is questionable. That definitely helps explain a lot here. The question for me is, how much further can we run on this fuel, and does it set up for a trap door? Which is my primary concern. But econ data, that's remained respectable. We haven't seen that fall off the cliff. Earnings data definitely taking a hit, but we're not seeing that depth of earnings recession that some people feared. We'll see how that continues into Q1 and these higher valuations, if that impacts psyche. But that's kind of the big market picture that I'm looking at. But what's your recap on and thoughts on this discussion and what you're looking at going forward?
So I think that I'm gonna try to figure out. I mean, what I'm consumed with right now is understanding how rebalanced we just got, because there have been, like, we had if you look at the robo and the lobo charts we looked at earlier, and you look at the festering of the low bullish percentage in the AAII, we clearly got to a period where an upward crash in the market was possible. And it's just, the question is, well, there's two main questions, but one of them is, how rebalanced have we gotten over the last, say, 3-4 days? We've certainly moved that needle a lot. We've had enormous call buying in that time. We've had a tremendous amount of shifting of positioning, a tremendous amount of capitulation for bears. And that's it hasn't been enough. Are we at the point, or are they holding up? We've got one guy in feedback, which I know you know very well. We've commented on him to each other for the last year. Um, he's just so bearish, and he's just always doubling down on, S&P shorts and Tesla shorts and Apple shorts, and he tends to tell us about every single trade throughout the day. So we get 50
Mm-hmm.
feedbacks a day on his doubling down. And, I mean, is that indicative of a lot of folks? And so we're not rebalancing. And I think that you can start to feel that out by the tape and by the tone of the market and some of the future data that we get on options. So it's really important to see those factors come in. But then obviously the other thing is, we're the two narratives that I suggested. One is, the possibility that this is team transitory is vindicated, and we can have a jobs report like that, and we're still going to see the disinflation because the supply chains are opening, and we're still in this structural lowflation. That's not impossible. Versus, this translates through to wage growth, and this services super core just stays where it is, and we start to see commodities bounce, and suddenly we're back at 8% CPI, and terminal rate for the Fed heads to 7+%, and that's a very different world. So I think these are the questions that you have to be watching.
Yeah. And that is exactly what we will be following and discussing in our commentary in the mornings. So I think that is going to wrap us up over here, Brett. I will be stopping audio, and we'll be restarting it here in a little bit. I'm not sure what's going on with audio in the afternoon. I will be off the desk this afternoon. So I think we might be shutting it down once Jim leaves. So we'll keep you updated on that. But Brett, great discussion today. Hopefully, all our subs found it useful. By all means, fire in feedback questions there, and Brett and I will get to them over the next couple of days. But Brett, great talking with you today.
You
Unfortunately,
too.
it looks like you just got ticked out of
I
your
just got ticked right
S&P
out.
before.
Look
Yeah,
at
they
that,
hosed you
man.
on that. They hosed you on that.
They
You should have
did.
never moved your stop. No, just
All I had
kidding.
to do was not tighten. So for anybody who didn't tighten, my next target was around 4160. So
There you go. We're definitely eyeing that up. A little bit of a late day roll here. I'm not reading too much into that, certainly given the
this
frothy
happens, and
activity.
this
Yeah, a
is
little
part of
profit
trading.
taking. Yeah, this is a little bit of profit taking going on here. I don't see anything big negatives, and obviously we're overextended. So
I think we could end up at the lows of this morning.
yeah,
I think
wouldn't
we
su-
could end up at 4100 on Monday. That's
would,
why I put the trade on.
would not surprise me.
But I am not disturbed at all. I'm very happy right now.
Yeah,
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 very happy. I enjoy getting shaken out by the market. It doesn't in any way psychologically damage me for my next trade,
yeah.
because I
No,
enjoy it. It's fun. It's fun
shooter's
getting shaken out.
mentality. Shooter's
Hey,
mentality.
it's fun getting shaken out, man. It's just
Yeah.
part of the game.
It's
I respect the
it's fun.
market.
It's
Good
funner
job,
staying
market.
in. It's funner staying in. But we'll
It's
we'll we'll,
fun to
we'll
say,
give
but
them a
yeah,
shake.
but it can't. It's not going to. It's not going to panic me into a revenge trade,
Yeah.
because missed opportunities happen. And hey, good job, market.
There you go. There you go. All right, Brett. You have a great weekend there. Great talking to you, and we'll be
Too.
in touch, obviously.
All right.
So, all right, everybody. Like I said, just going to shut down this temporarily. We'll have it started back up shortly, and I will be posting the replay of this to the site in a little bit.
All right. Take care, guys.
Take care.